So the next thing we look at is the assignment to a spouse. Now remember that when Jack assigned it to his brother Jim, okay, that was an arm's length transaction. So there was in fact a deemed disposition. Now we're doing a non-arm's length transaction. So we're assigning the policy to a spouse or to a child, a grandchild, whatever. It is referred to as a non-arm's length transaction. So therefore, in this case here, we're assigning this the policy to the spouse. Okay? And therefore, the Income Tax Act allows for a spousal rollover. So basically, when you have a spouse, you don't. There is no actual deemed disposition at all, because what happens in a spousal rollover, if the spouse acquires the policy at the same adjusted cost base as the husband in this case here, so in this case, Jack, okay? So basically, if you remember that the ACV was $34,000. And yes, at that time of dispositions, the fair market value or cash surrender value was $61,000, so that's fine. However, because it is a spousal rollover, what we refer to as what we call intergenerational transfer, therefore, and under the Income Tax Act, we are allowed a rollover provision, basically between a husband and a wife. Let's say, okay, the proceeds are received now at $34,000. In other words, it is deemed here that the ACV of Jack will be transferred to his spouse as $34,000 as well. So therefore, in essence, what happens here is that the spouse receives the policy exact same ACV as Jack did. So the end result is at this point that there is no actual taxation whatsoever. Okay. Now, in the event that Jack decided that he doesn't want to do a rollover. In other words, he would prefer if he just paid the tax right up front, you might say, because he may be in a lower tax bracket, whatever the case may be, whatever it is. If he decided that he wanted to opt out of the rollover provision, that's perfectly fine. That's not a problem. And then again, that would be a situation where the difference between $34,000 and $61,000, which you remember was $27,000, okay, that then would be times Jack's marginal tax rate. And therefore, his wife now would have a new ACV of $61,000. But that is if they decide to opt out of the rollover provision. Okay. But if they decide to keep it as a rollover, then there is no taxation at this point. If he decides to opt out, then he pays his tax now, and the new ACV, of course, will be $61,000. Okay. Now, one of the things that have to be very careful is that if you decide not to, in other words, if you decide that not to opt out of the rollover provision. In other words, you want to keep the policy going and everything else, okay? And therefore, your spouse receives it at your ACV. One of the big issues with that is what we call the attribution rules, okay? So let's say at some point in the future, your spouse ends up actually cashing in the policy, because remember now the spouse now owns that policy. So Jack's giving it to his spouse basically, and he decided to basically not to opt out of the rollover provision, basically, okay? In that case then, at some future date, when his wife actually turns around and cashes the policy in, there's $94,000, let's say, sitting in there, then the difference between the $34,000 and the $94,000 will be taxed, will be the policy gain, and that will be subject to taxation. Now, because it's attribution and because it is the spouse situation, Jack is still responsible for that tax. So even though his spouse will get the check, let's say, for $94,000, the responsibility of paying the tax still lies with Jack, because he decided not to basically opt out of the rollover provision. Had he done had he opted out, then his wife would have received the policy at $61,000. He would have paid the tax on it, fine, and then all future gains would be in the hands of the spouse. Okay. But in this case here, if he decided, no, I'm not going to opt out of the rollover provision, I'm just going to leave it alone, I don't want to have to pay tax right now, that's perfectly fine. There's nothing wrong with doing that. Just be aware, of course, that at some point in the future, when his wife ends up cashing the policy in, then the attribution rules could apply, and therefore the difference between the ACB, which is what she acquired at $34,000, and the amount of money that's actually been disposed of at the other end, that could create a taxable situation for Jack, not so much for his wife, but it's more for Jack. So you always have to be careful when you're transferring property to your spouse, that there could be attribution rules, which is beyond the scope of this particular lesson, but just be aware that the attribution rules are there, and they're quite onerous. Like I say, it's beyond the scope of this particular lesson. Okay, so that is an example, basically, of a non-arm's length transaction transferring it to a spouse.